Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
So let's dig into the trenches. When you are brought in on the sell side, because you're equally, working on both sides, buy side, sell side.
Right.
But when we talk about the sell side, what are the most common gaps or red flags that you have uncovered while doing that?
As I just mentioned, I think the major one is just that accounting for the company complies with seller preferences.
Yeah.
Also, a lot of times books aren't closed at interim dates. They're only closed annually, which doesn't give buyers current information.
Yeah.
There are also even companies that are audited, though, are allowed under audit standards, materiality thresholds that if you apply a multiple to those are pretty material. They're going to be very influential on a deal. So a lot of times if they're working with an accounting firm and they've applied their own interpretations of rules, they're going to find that when a buyer looks at those, that might not be how the buyer would do it. There are also even adjustments that audit firms will, so-called waived adjustments or past adjustments year after year after year, that might mean something for a buyer. So all of these things combine to create these gaps. And I don't mean GAAP, generally accepted accounting principles, but it's a nice pun, but gap.
Yeah.
And
It's a gap.
and that's the issue. That's the issue.
Yep. It's a gap in the gaps.
There you go. There you go. You got it. You got it.
Absolutely. And especially in accounting firm M&A, because accounting is a business which is very much relationship driven, and mostly owners hold most of the client relationships personally, which also adds another layer of risk. Welcome back to another episode of Accounting M&A Insider. I'm your host Saul, and today we are diving into one of the most misunderstood and frankly most painful parts of any M&A deal: sell-side due diligence. If you ever thought I'll put my firm on the market and let the buyer figure everything out, today's conversation will save you a lot of heartbreaks and probably a few $100,000 as well. My guest is someone who lives and breathes this topic. Bill Wiers, partner at Miller Cooper, nearly 40 years into the business, author of multiple books, speaker at Kellogg's, Columbia, and several major M&A forums. So Bill has seen more deals succeed and fail than most of us can even imagine. So Bill, welcome to the show.
Well, thank you so much, Saul. And by the way, I know you're reading from a bio that my mother wrote, but I want to thank you seriously so much for that introduction. And I also want to thank the listeners who are taking the time to tune in and listen. As Saul said, I'm Bill Wiers, principal with Miller Cooper and Company. We're a regional accounting and consulting firm, and I'm quite honored to be on this podcast today.
Absolutely, Bill. The honor is likely mine. Now, Bill, your background is incredible. Almost 4 decades at Miller Cooper, authoring books, teaching at top MBA programs. That's not something that I see in someone taking. It's not a typical accounting career path. So how do you end up specializing in M&A and more specifically in the sell side due diligence?
Well, first of all, Saul, it's true that I've been at this nearly 40 years, but you have to remember I started right out of kindergarten. So that's the first thing to keep in mind. But but as far as the firm, let me tell you a little bit about the firm, then I'll get into how I got into M&A. Miller Cooper is a 600-person accounting and consulting firm, as I mentioned earlier, that was actually founded in 1919. So we celebrated our 100th anniversary 6 years ago. I'm an audit partner, and I'm actually the relationship principal on a 106-year client of the firm who's been with us the entire time. So that's the legacy of the firm. As far as how I got involved in the due diligence specialty, I saw a real need for it. I saw sellers leaving money on the table, not getting what they were due because they weren't prepared, because they didn't know what to expect, because they
Yeah.
hadn't been through, for example, the lectures that I've given at Columbia and Kellogg, and they just didn't know what to expect, and therefore they didn't maximize their value. So I started this group about 25 years ago. We've grown it substantially. I'm now involved in a variety of transactions, from public company divestitures all the way to growth companies or startup in the middle market in between, enterprise values from about 5 to 500 million. And I
Wow.
pride myself on adding for my clients 6 to 8 figures per deal, either in savings or additional value that might have been left on the table.
Nice, nice. I like that. And I'm pretty certain a lot of our listeners, they are really liking this and they really want to know more. And, the reason why I wanted you on this podcast is because, you're all about, making technical topics practical, right? And honestly, that's what sellers need, because for many of them, this is probably the first and the only deal of their lives that will significantly impact the trajectory of their life forward. So let me ask, teaching at top schools like Kellogg and Columbia, working with searchers and future CEOs, how has that shaped the way you explain M&A readiness to business owners?
Well, let me respond this way. It leads to a painful realization, as I mentioned earlier, that a lot of sellers just haven't been through this type of training. And I realize how important it is for me to be proactive as an advisor. And that means engaging in continuous learning. I'm never done. I never rest. I'm always looking at what the new GAAP rules are, which is generally accepted accounting principles, the tax rules that impact transactions, also what's going on in the world, because all of this impacts
Yeah,
clients. So some of the more recent things that we may or may not get into today, if we have
yeah,
time, but new revenue recognition rules just
yeah,
resounded throughout industry. We had a new tax bill in July. We also
yeah,
had a Wayfair decision, which expanded the ability of state taxes to expand. And then, of course, we had all the external events, things like tariffs. We had the pandemic. All of
yeah,
these things had huge impacts on how you look at companies. I actually, during both of those events, during both tariffs and pandemic, saw deals crumble due to those events. So all of these things you need to strategize, you need to be aware of, and how do they impact your deal? How do they impact what you're presenting? You need to be proactive. And as I said, I see that as my role, but it would be nice if my sellers had time and interest to engage in a course, but most of the time they haven't, and therefore I'm helping them get through it with my knowledge.
wow, I love it. And I think that's why, that is why the sellers are resonating with your approach. You keep it very clear. You like to bring clarity over complexity, because I think while I was researching about you, I think I read one of your quotes. Deals don't die because of price; they die because sellers go to market unprepared. Right. So let's
All
start there. All right.
right, good.
Unpreparedness. So, what are the top three issues, or maybe more, that you see that cause deals to fall apart?
Right. So lack of seller preparation is number one. And what can happen, unfortunately, is that if sellers don't prepare, they can be blindsided during due diligence by issues that the buyer's due diligence team raises. And you have to
Yeah,
keep in mind that a lot of times the buyers they're dealing with, unlike them, have been through this many times, have done due diligence many times before. And when they bring up issues, sellers may perceive that they're being chiseled or that the buyer's being mean, and they may want to break off deals. And I've seen that happen. When sellers don't prepare, they react unfavorably to issues
yeah,
that are brought up. So it's a huge thing to get them prepared and make sure that they have already accounted for and identified issues ahead of time. And that's where sell side diligence comes in. There are
yeah,
other things that cause deals to fall apart, things like recent changes in the business.
yeah,
These can be brought about simply by what's going on within the company, but as I mentioned a minute ago, also external events that may
yeah.
cause deals to break apart.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
True, true, true. And I think you bring out a very powerful point, especially, when the buyer starts asking you, and then you think that, oh, I think this is, you kind of like feel like, you're losing trust, because you're like, oh, why are you asking me this? I've run this business for quite a while. But rightly said, the buyers have done this for quite a while. So they're probably just trying to get clarity on things. Uh, but, selling a farm is an emotional affair for owners. It's something that they built, a farm that they built with their sweat and their blood and everything, and now they're going to be passing that baton on to somebody else. So trust is, I think, at the very center of all these conversations. But if you're not prepared, you may feel that the trust is eroding, and that kind of like, once that happens, the deal just basically goes. But you've been at the other, and like you said, you've seen that because of this a lot of the deals have fallen apart because of the lack of preparedness. So can you share a real life example, no names of course, where the lack of preparation or of a gap non-compliance completely derailed a deal?
Here's an extreme one, but it gets the point across. I was engaged to do buy side due diligence, and I do that about half the time. I'm split half and half, so I go
Yeah.
both ways on due diligence. But I was engaged to do a buy side on a small manufacturer that was owned by a brilliant engineer. And this was a person who custom wrote his entire software system. It gave him ERP, it gave him CRM,
Wow.
all the information he ever wanted because he was brilliant. He could do this, and he did. The only problem with his software was the accounting side, as far as I could tell. On the accounting
Oh.
side, he wasn't real aware of double entry bookkeeping and the need that books have to be in balance and so forth. And what happened was for 30 years, an outside CPA had come in once a month and prepared financial statements that no one looked at that were used
Yeah.
for the tax returns, and he
Yeah.
plugged the numbers. He actually just had to make it work. He had to download transactions and then plug things to what the owner said they were. For example, receivables, inventory. All these things had to be plugged so that in the end, when I was given monthly financial statements to look at, all I saw was, oh my gosh, fluctuations up and down, inconsistencies. Couldn't tell really what was going on. And when I was asked by my buyer, could I derive a reliable 12-month or trailing 12-month EBITDA number, I had to be quite honest and say, no, I couldn't, because I really
Yeah.
couldn't make sense of the numbers that were in front of me. And fairly early on, my buyer decided, and with my consultation, that we actually would have needed to rebuild their accounting from scratch in order to get good information. So that's an extreme example. Obviously, that doesn't happen all the time. But let me
Yeah.
raise another one that might be a little bit more common. So again, I was representing an investor, potential investor in a SaaS company, software as a service business, who billed annually in advance for its services. And we were presented with financial statements that showed wonderful revenue and cash in the bank. And wow, that looked great until you realize that they had not deferred the revenue that hadn't been earned yet. And even though these fees are not refundable, they have to
Yeah.
be recorded as earned under GAAP. So
Yeah.
actually, you need to show a liability for future services on your balance sheet. And once we recorded that and estimated what that was, it overwhelmed the cash balance. So they
Yeah.
were actually spending that money that they'd received in advance for services not yet provided on current operating expenses. They were
True.
actually insolvent, and my investor realized that all the funding that they were asked to provide would do is really just fund another year of losses, and that would be it. And this
Oh
company
my
would
God.
need to reach out for more money. So that's another example of where deals can fall apart. And in part it's due to GAAP, but all the GAAP issues I bring up have very practical
Yeah.
implications and aspects to them.
Yeah. I mean, it sounds simple, but these are some very important things when you're looking at it from a buyer's lens or from an investor's lens. It makes a lot of sense. In fact, you mentioned about a trailing 12-month EBITDA, if you could bring that out for one of those firms, and you couldn't. But this is something very funny because when I speak to some sellers that I've spoken to, I have come across a few sellers wherein they've said that, can I now just send you my profit and loss and a balance sheet, and would not be enough? I mean, I tell them that, okay, no, I mean, that's just like the starting point. Yes, you can send that to me to get started, but then there's a
Right.
lot beyond it. There's so many other things that you got to look at. But but I just don't understand, why is that mindset such a dangerous misconception? And it's difficult for me to explain to them that you just can't think that your profit and loss and balance sheet is enough to get you valued. I'm not able to break that misconception, but probably you can shed some light for our listeners to let them know that it's not just the P&L and balance sheet. There's a lot more beyond that goes in the deal.
Exactly. And I'd say, first of all, that buyers expect what is called compliance with generally accepted accounting principles, which is GAAP. And frequently, sellers of middle market businesses have adapted their records to their own preferences, whether that's income tax basis or cash basis, or they've engaged in methods. I've had companies, for example, that like to record revenue at order, even though they haven't manufactured the items yet.
Hmm.
There are a number of things that are built into systems, and a lot of times owners don't really think twice about it because, like that brilliant engineer, they have a CPA coming in every month and they think things are going to be fine. But
Yeah.
unfortunately, if you present your financials just off your system without having a look at that from how a buyer would look at it, what the perspective they would bring, you risk driving away buyers. And it's not only after they engage in due diligence, but even before they start, because what they
Yeah.
may perceive when they look at your financial statements is that there would be so much work involved to straighten them out that they'll move on to a different deal that's in better shape, that where they can analyze the information more easily and they can determine whether they have interest or not. Because if they have to make a huge upfront investment, even just to determine what's there, that itself may drive them away.
Interesting. And we talked about like sellers not following GAAP protocols, which is very weird and rare. But I mean, that does happen because you've seen that happen. So let's dig into the trenches. When you are brought in on the sell side, because
Mm-hmm.
you're equally working on both sides, buy side, sell
Right.
side. But when we talk about the sell side, what
Mhm.
are the most common gaps or red flags that you have uncovered while doing that?
As I just mentioned, I think the major one is just that accounting for the company complies with seller preferences.
Yeah.
Also, a lot of times books aren't closed at interim dates, they're only closed annually, which doesn't give
Yeah.
buyers current information.
Yeah.
There are also even companies that are audited, though, are allowed under audit standards
Yeah.
materiality thresholds that if you apply a multiple to those are pretty material. They're going to be
Yeah.
very influential on a deal. So a lot of times if they're working with an accounting firm and they've applied their own interpretations of rules, they're going to find that when a buyer looks at those, that might not be how the buyer would do it. There are also
Yeah.
even adjustments that audit firms will, so-called waived adjustments or past adjustments year after year after year, that might mean something for a buyer. So all of
Yeah.
these things combine to create these gaps. And I don't mean GAAP, generally accepted accounting principles, but it's a
Yeah.
nice pun, but gap.
Yeah.
And
It's a
that's
gap.
that's the issue. That's the issue.
Yep. Yep. It's a gap in the gaps.
There you go. There you go. You got it. You got it.
Absolutely. And especially in accounting firm M&A, because accounting is a business which is very much relationship driven, and mostly owners hold most of the client relationships personally, which also adds another layer of risk, which a lot of firm owners don't quite realize. So, in your view, how should that factor into due diligence and valuation conversations?
No, I'd say though that that is more of an operational than a financial consideration, and
Right?
certainly, though it's very a very important point because particularly private equity and a lot of financial buyers aren't looking to run the company post closing, and
Yeah.
so what sellers need to do over time is have developed a management team that's capable of carrying on the business after they're gone. And that's more of a succession planning type of issue.
Yes.
Certainly something, though, that buyers are aware of and certainly are concerned about,
Yeah.
is the
Yeah.
level of owner dependence is what it's called.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
Yeah. Yeah. Owner dependence. That's the term. Absolutely. I agree to you. How many hours are you putting into that?
Right.
And that significantly impacts. Now, and I completely agree with everything that you said. And in many deals that I've seen, the buyers especially pay for the owners' relationships when those aren't transferable, because there is a relationship with the seller has got a relationship with the client. But if those relationships are transferable, the deal structure often completely can change dramatically,
Mm-hmm.
because that could be
Oh, yeah.
critical. Now,
Right.
now, sometimes sellers rarely understand that uh, sell side diligence versus buyer diligence. They
Mm-hmm.
often don't understand the difference. So, how are they different, and why should sellers invest in their own diligence upfront?
Well, buyers, frankly, and I do a lot of buy-side diligence, as I mentioned, frankly, buyers will come in with a very conservative mindset. So if there are
Right.
issues identified because of the uncertainty that buyers have, because
Yeah.
they don't control the records, they'll tend to interpret them in as negative and conservative way as possible because they want to
Right.
protect their client, they want to be protected.
Yeah.
So if you, as a seller, are not aware of those issues and haven't planned for them in advance, you're going to be blindsided, you're going to be reactive, you may
Yeah.
become frustrated, you may withdraw from the deal. But if you do sell side diligence, the
Yeah.
idea would be not to sweep issues under the rug, but rather bring them out in the open
Yeah.
and be able to present them in a
Yeah.
way that optimizes their resolution. And let me give you a quick example. So I worked
Sure.
with a company that was audited that had inventory, and it had an inventory reserve, which means that you're carrying your inventory. If it's below cost, you're carrying it at its net realizable value. That's what GAAP requires you to do. But this reserve decreased during the period that the buyer was looking at, and the buy side diligence team interpreted that reduction in a reserve as a reduction in cost of goods sold and therefore an increment to EBITDA, and they wouldn't allow the company to have that in EBITDA. They
Yeah.
actually posted it as a suggested reduction to EBITDA. And the
Yeah.
fact of the matter was that even though it was only a few $100,000, when you applied a multiple, it was in the millions. And
Yeah.
the seller perceived that, oh my gosh, this is going to ruin the whole deal for me, what I thought I was going to get. They became disenchanted. They broke off the entire transaction over this. But what happened subsequently is that, yes, the seller tried again, and their investment bank suggested bringing me in. I mean, it could have been other sell side providers. I'm not just saying I'm the only one who would have done this, but when I looked at it, what I was able to document for them was that that reduction in reserve was actually inventory that was thrown away, that was donated for
Yeah.
charity, and also negative margin sales that occurred during the period. And when I added up those things and documented them in the report, it became a complete non-issue for the next buyer.
Yeah.
And
Yeah.
I love
Yeah.
it when I'm able to help clients that way. And that again is what caused me to want to develop this specialty when I saw that I could add that type of value.
Nice. I like this. I really love that example, because that's what sell side due diligence is all about. You may have run the business, but maybe there are some matters. And when it comes to that point, it's better to be upfront, get everything out in the open. And it's a good start of a conversation, right? Okay, this is where I am, and these are the things that need to be looked into, or these are the things that may caught you off guard, but this is the reason for why they are that way. When you're able to
Exactly.
have a reasoning there, it really helps. Now, selling, buying a business is one thing, and everybody wants that to be done. And the moment you sign the agreement, and then the ink is dry, and you're like, all right, this is good. I've sold my farm. The buyer's like, okay, I bought a farm. But the real story starts after that. You've written extensively about post-closing M&A disputes. like the working capital adjustments, earn-out disagreements, indemnity claims. So, how
Mhm.
do, excuse me,
Right.
so how often do these disputes occur because of issues that could have been caught in sell-side due diligence?
Well, and I might not have included this in my bio, but I also represent parties as an expert in post-close litigation relating to
Nice.
those disputes, which gives me particular insight into what type of deficiencies in the agreement that may have given rise to the
Yeah.
problems. Frequently, where they arise is from apples to oranges. In other words, the
Okay.
seller has always done it according to their practices. The buyer, in the name of GAAP, is bringing in a different practice. So I mentioned inventory reserves earlier. It could be receivables reserves, those types of things,
Yeah.
where the owner of the company might say, well, I know it when I see it. That's how they deal with reserves. They write off things when they see them, whereas the buyer, being more cautious, seeks something more formulaic. For example, anything over 90 days in receivables is bad, and any inventory that is in excess of a year's supply needs a reserve. And
Yeah.
so that can lead to, unless the agreement is worded appropriately, that
Yeah.
can lead to disputes post-closing. So, for
Yeah.
example, if a seller agrees to GAAP, generally accepted accounting principles, that's a bad thing because GAAP contemplates a lot of different methodologies for estimation. It even contemplates different methods. If you think about last and first out versus first and first out is an easy example for inventory.
Yeah.
So all of these things can come to a head unless the agreement is well thought out. And what I tell people is to listen to what their moms told them. And what do their
Yeah.
moms tell them? Watch your language. That's what your mom told you. You got to do that for M&A agreements as well.
Yep. Yep. And it's so true, everything that you're saying. Many disputes, they start with just misaligned expectations, not really malice. And that's why the emotions kick in. Sellers often feel like the buyers are trying to chisel them down, and that just kind of like blows the entire thing off. Now, Bill, with your experience, I want to get a little bit technical. If a seller is listening right now and they want to prepare properly, what would be the top items on your sell side due diligence checklist?
Ah, wonderful. Well, I guess first of all, as an overview, I need to mention that sellers are best off being prepared. They should not be blindsided or reactive. They need to know the issues beforehand, and they need to understand that buyers are rightfully cautious. The sellers control everything prior to closing, and they're going to want to scrutinize, get comfort with things. And that's where
Yeah.
sell side due diligence comes in. But as far as the steps that I go through, particularly the help would be in the areas of add backs, generally
Okay.
accepted accounting principle, compliance, and then taxes as needed. And add backs, what I'm talking about is those expenses that would not be expected to continue under the buyer. And there may be various things. There may be
Yeah.
things, I mean, most obvious would be if they have an investment bank and they're spending dollars on that, that would be added back. But there might even be new product development or discretionary bonuses, excess bad debts. There might be R&D, things
Yeah.
that won't continue under the buyer, and the seller should actually get credit for. And what sell side diligence helps sellers do is to identify those items and then to support them and make sure they're presented in a credible fashion. So we're also a sounding board. We don't want to exaggerate, but we want to make sure that what we're presenting is reasonable, supportable, and we work with sellers on that. And then as far as generally accepted accounting principles, frequently just people aren't aware of what they're doing isn't quite correct. And I gave an example of inventory reserves earlier, but I could give a quick one on a company that manufactured custom items. As I mentioned earlier, a company that recognized revenue at order at the point that the customer signed off an order because they wanted to motivate their sales staff. So that was revenue. And they had an outside accounting firm who developed an algorithm that would measure a number of weeks worth of revenue that would be reversed. And they used that algorithm for years. But when I came in on the buy side, the first thing I noticed was, and this was on day one, that when I went through and talked to the internal accounting folks, we're family members. They didn't have a lot of a formal accounting training. But when I talked to them about what was actually going on, it turned out that the algorithm used was wrong and that the lead times were actually longer and there was more revenue that should have been removed. And there was a 7-figure adjustment downward to receivables and to EBITDA. And that
Wow.
really threw the entire transaction on day one into question. But what we decided to do with the buyer was give them a chance to correct the records. And it meant for the accounting firm that they actually not only amended tax returns, but they reissued their reviewed financial statements. And so we came back 90 days later with revised information, a revised offer, and we were able to close successfully. So
Nice.
that is the type of thing, though, that you want to avoid because potentially a buyer might have just walked away at that point. We were able to salvage the deal, but potentially a buyer might have walked away and the seller thought nothing was wrong. They thought their accounting firm, even if they were non-compliant, they thought the accounting firm had handled it. But unfortunately, a lot of times accounting firms in those situations are treated as a black box. They're fed information, they feed it back. And unfortunately, the accounting firm doesn't always even have the information to re-review what they propose and how they're treating items such as that revenue. And then as far as taxes, my goodness, I mentioned all the new things that are going on earlier. One of those was a Supreme Court decision called Wayfair back in 2018. And that expanded the reach of states, other than for income taxes, which are restricted by federal law, but it expanded the reach of states not only for sales tax, but other types of taxes they might have, taxes on capital, taxes on gross receipts, and so forth, to consider what's called economic nexus. And I know that sounds very academic and complex, but in reality, it isn't. It means that if you sell into my state, you're subject to my rules, and you are going to have to register withhold and remit sales tax, and also potentially be subject to these other taxes I mentioned that would be non-income taxes. And there are 10,000 taxing jurisdictions in the United States, if you can imagine. So it's not just the 50 states and all the counties, and there's municipalities too. 10,000 of them, and all of them are out there making new rules and trying to optimize the situation for themselves. So unless you're aware of these things, you may be blindsided during due diligence and, oh my gosh, I should have been filing in Hawaii because they don't have a manufacturing exemption, and I sold more than $100,000 in spare parts to them, a customer there, over the trailing 12 months. So those are the types of things that can happen. Another issue with earlier stage companies that frequently comes up is paying people as independent contractors, and that's a no-no. There's a 20-part test that the IRS imposes, and in addition to that, both state departments of employment security and the Department of Labor have their own criteria for what constitutes a contractor relationship. And it's very restrictive. And if you don't meet those criteria, believe it or not, company owners can be even personally liable for those taxes and penalties, even if they shut down the business, sell the business. What could happen, and I've seen happen, is what's called piercing the corporate veil. In other words, owners are personally liable. So a big deal. And these are things, even during a transaction, because I'm part of a 600-person firm, I have specialists within the firm that deal with these issues all the time. They deal with sales tax. They deal with HR issues like independent contractors. So if issues come up either before or after buyers come in, we're able to gear up and help present again in the best possible light. Now, sometimes you have to give on some issues, but other times there are mitigating circumstances. There may even be, for example, states offer amnesty programs that might be running. There might be ways to mitigate issues, or if even more than that, though, to undo issues, because again, buyers tend to be very conservative in how they look at these things.
Wow.
Mm-hmm.
Bill, I mean, this is gold, everything that you're saying. I mean, I know it's a lot. And I mean, I pray, the sellers who are listening in, even if you're able to get half of that done, I think that would be a really good starting point. But I'll just top that question that I asked with another very interesting question, because I don't really have an answer, but I would ask somebody experienced as you. because the sellers are going to ask, all right, I know I need to get prepared whenever that's going to happen, succession planning, everything. But how soon do I start preparing for this?
Oh, how's now, Sal? Let's get started. No, I'm kidding. Generally, I'm brought in when the seller engages an investment bank or broker to sell the business. That's generally when I'm brought in because our engagement would be over, say, a 3 to 4 week time
Yeah.
span generally. Although if accounting work is involved, sometimes I'll need to bring in a department of my firm, which is fractional CFO services, to try and get the books in shape where we could perform sell-side due diligence. So that would be a longer lead time, but generally it's 3 to 4 weeks. However, seller planning should start a lot earlier when it comes to things like estate and gift.
Right.
And the difficulty is you can't do those things at the last minute. You need to have
Yeah.
valuation work and you need to have the agreements written. I'd suggest probably at least a year in advance of doing a transaction. And we talked about
Yeah.
earlier management succession.
Yeah.
Wow, let's talk about years lead time in order to get that in place. So a lot of things to be done. And some sellers will prefer to get me involved earlier before they're going to market, which is fine too. But I don't want to tell sellers that they're foreclosed from benefiting and using my services, even if they wait until 3 or 4 weeks before they go to market.
All right. Now, before this podcast, I mean, like we did speak about a lot of things, but you also mentioned about the changing taxes and everything, because those are the factors that can affect. You also talked about the revenue recognition that is significantly changing. So now that we have a little bit of time, would you like to just touch on that point, how that is impacting deals?
Which one? The revenue recognition?
Yeah, the revenue recognition. Yeah.
Yeah, so it seems to come up in every deal. And the reason is what happened that the accounting rules expanded in 2019 to what's called ASC 606. It's a technical term. And what it brought to predominance now, as far as consideration, is what's called overtime revenue recognition. And you can liken that to what used to be required of contractors. It was called percentage of completion. It was applied to long-term contracts. But now you're seeing it everywhere. You're seeing it in software companies, professional services firms. You're seeing it in even custom manufacturing. There are a lot of different industries, types of businesses that now are expected to be on this that previously hadn't really given it much thought. They went with industry practices or they went with their software. So, for example, QuickBooks, which a lot of companies use, will record revenue at the point that you invoice. If you want
Yeah.
to record over time, which would mean as earned rather as opposed to when you invoice, then that is going to take effort. So you're going to have to engage in getting someone to help you implement it. I actually, believe it or not, encountered a couple of situations very recently with revenue recognition that your listeners may find interesting. First of all, I had a seller who was a contractor and they brought in a huge contract. And what they thought was they could record that contract as revenue as soon as it was signed, even though it didn't start for a month or two and it would go on for several months after that. And they
Yeah.
thought that that would be okay. And when I kind of unfortunately had to slow them down a little on that thought process, they decided to defer going to market because they weren't going to achieve the target EBITDA that they want to. I'm
Yeah.
also involved in a transaction with a custom manufacturer and installer that is definitely subject to percentage of completion revenue recognition. And with them, they're properly recording inventory on their balance sheet for items that they're building. They're capitalizing labor and overhead as best they can. But they also have 50% down payments or progress payments during the course of the project that they're taking directly into revenue as they invoice them. And the business is growing, so this deposit amount is growing and growing. And what happens is when you get rid of the effect of that, basically the mismatch that's arising because you're recognizing revenue before the job is done,
It happens. Yeah.
not only do you have a reduction to EBITDA, which is substantial, you also have a big liability you have to worry about at closing that the buyer, assuming they're knowledgeable, will want transfers to them because these progress payments, these deposits are intended as funding for the project. So you
Yes.
can imagine if the buyer closed and on a cash-free, debt-free deal, which is typical for everyone, cash-free, debt-free, the seller will keep that cash It
Yeah.
means that the buyer has to scramble for funding to complete those projects. They won't have the cash that the seller has received and took with them at closing to complete the work. So it could be very devastating if a buyer isn't aware of that and if there isn't a mechanism put together. But this came as a shock to the seller who thought that, well, with deposits, for example, they reverse themselves, right? Over
Oh,
time,
right.
everything's fine. Everything equals out.
Nice.
That's true. However, when you take that snapshot at closing, that's kind of when in musical chairs, when the music stops and everyone runs for a seat.
Yeah.
Because if that cash isn't there for the buyer, they're going to be in big trouble post
They are.
closing.
Absolutely. Absolutely. I really love the analogy, the way you put it. It makes perfect sense, right? So now, Bill, this has been insightful. And before we wrap up, if you could give one piece of advice to a seller who is considering putting their firm on the market in the next year or two, what would it be?
I'd say, well, and I hate to sound like a broken record, but I think preparing by engaging a sell side service to perform sell side due diligence is very important, because not only does it facilitate the transaction because it provides information to buyers, and makes for better offers, but it also even adds value. And I'm told by investment bankers that it adds a half to a full turn of value to a deal. So, for example, let's say your business has an adjusted EBITDA of $1 million. It means an extra 500,000 or $1 million in price that you'll achieve by going through sell side due diligence. So when you think about that compared to the fees that I charge and others, it's not even a rounding error a lot of times on the value of the transaction. So definitely worth doing. In addition, I mean, there's just so many benefits to it, that, well, first of all, I should say that investment banks that I work with, many of them require it. So it's not even
Yeah.
optional. They're going to have you go through it regardless. But as a seller, you're going to get confidence, you're going to maximize your value, you're going to be able to identify and mitigate with problems well in advance. And so you also attain that credibility, presenting information that's been vetted out already by a third party outside due diligence provider that's independent. All of that builds credibility. But to everyone, the biggest benefit is this: it increases the likelihood that there will be a closing on the original terms that the buyer offered, that there won't be a retrade, there won't be a broken deal. And that's important to everyone, because in the end, if there are broken deals, you're wasting everyone's time and money.
Yeah.
And
Right.
most of all, the seller doesn't achieve their objectives. They went in
Yeah.
trying to sell their business and they didn't sell. And so
Yeah.
it's just a terrible outcome for everybody.
Perfectly said, Bill.
Thank you.
Yeah. I mean, preparation protects value, right?
Mhm.
And unprepared sellers often leave money on the table, or worse, lose the deal entirely, like you rightly said. So this has been insightful. Now, before I let you go, where
Mhm.
can listeners find more of your writing, your articles, or connect with you directly?
I want to thank you so much for asking, Saul, because
Yeah.
I would encourage everyone to please link with me on LinkedIn. And if you could spell Wiersema, Wiersema, you can find me. Because what I do on LinkedIn is, not only is there a lot of information about me and so forth, but I post very frequently on current topics that'll be of interest to sellers and other listeners. But I also sometimes post on fun things, and I most certainly will be posting on this podcast.
All
So it's
right.
all there. And as I said, I encourage you to please do it. Please let me know you've listened to the show, and definitely I'd love to have you as a
Absolutely.
connection. Thank you
Yep,
so much.
absolutely. Thank you, Bill. It's been an honor. And to all our listeners, don't worry about finding Bill. I will have his LinkedIn URL included into the show note description, so you can directly reach from there to Bill, connect with him, follow him, and get that wisdom that he has acquired over the years. And with that, Bill, thank you again.
Thank
Your
you so
insight.
much.
Absolutely. Your insights are exactly what the accounting M&A world needs. All right. So, and for everybody who is listening, if you're planning to sell, thinking of selling, or even just curious, replay this episode. All right. There's more wisdom packed into this than most people get in an entire deal cycle. So with that, I want to thank you all. We'll see you in the next episode of Accounting M&A Insider. Till then, take care. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.